Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Nuts and Bolts of Real Estate Investing podcast. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how are you doing today?
All good in the hood, Joe. Once again, sitting here getting sunshine in my eyes in my my home office here that I sit at here to record these podcasts, which feels nice. Get a little
nice.
Vitamin D up in the joint here. Where are you at?
I'm in Steamboat Springs, Colorado right now, which it's kind of overcast, actually.
I thought I heard something crazy about Colorado. What did I hear about Colorado recently that was nutty? Can't remember. Lots of stuff going on. Are you in a blizzardy type of environment over there again, or what?
You know, it kind of feels like it's shifted to spring, to be honest with you.
Yeah?
Yeah, I mean, it's cold, but we haven't seen a snowstorm since the last time we talked about seeing a snowstorm, and it's pretty much been warmer temperatures, like getting up into the mid-30s during the day.
Yeah, would you consider that spring skiing conditions or not quite yet?
A little, getting there. We had a couple inches of snow over the last few days, but it hasn't been fantastic. And you know, because it's warmed up, you see people shedding layers off, and it feels like spring skiing is right around the corner.
Yeah, what are you guys doing in the? You're going to stick to the spring skiing. Us Clarkies, we have spring break coming up here in mid-April, and we are going to. We got the coronavirus spring break, which is an interesting one. Half the school seems like they're going to Hawaii, but we are going to do something different this year, and we are going to road trip it.
Yeah.
With buddy. And we're going to go to Lake Tahoe.
Really?
Yeah.
Cool.
Yeah. Totally stoked.
I love that area.
So we're just going to take our time, stop on the way and then head to Tahoe for a few days, try and get in some spring snowboarding out there or whatever fun we can find. And then ideally maybe head back towards San Francisco because I'm originally from the Bay Area. We were going to go to Six Flags or something like that on the way back, but now with all this virus stuff, we might not be able to do that. We'll see. But and then head back down the coast. Isn't that like Highway 101? I haven't figured it all out yet, right? And just kind of
that's the best drive ever.
Take our time, have Buddy with us, and road trip.
That's fantastic.
Yeah. So if you feel like meeting us, drive our direction. There you go.
Yeah, well, we're going to go definitely through Tahoe on our way back down to Colorado, but I don't know exactly what it is, but we'll have to definitely.
Well, we're going to be there probably around April 11th. So put that up into your noodle there.
Cool.
Yeah. So I'm feeling pretty smart about our decision. That's my smooth transition today for the podcast guys and gals, because today on the podcast, we have Tim Shoultz, who is the co-founder and CEO of SmartCap. Previously, back in 2019, earlier in the year, we had Joe Allis, his partner, on with us, and we're talking about opportunity zones and opportunity zone funds and commercial real estate and industrial real estate and all that stuff, warehouse projects. We're going to jump in that today and get an update on the Opportunity Zone Fund investing arena, as well as learning more about what SmartCap is up to. Let me just preface this by saying Tim Shoultz and Joe Allis of SmartCap they're like the pioneers in the Pacific Northwest of the Opportunity Zone Fund arena, and we're going to check in with Tim today on the podcast so we can all keep current about how Opportunity Zone funds work and how they can help us as investors manage our wealth with tax planning through Opportunity Zone funds. Does that sound about right, Tim?
That sounds great. Thanks for having me on. I'm really excited to be here today, and looking forward to giving you guys an update and just kind of talking about real estate in general. It's something I love, so it should be a fun morning.
Let's do it. I'm going to a little bit more about SmartCap, everybody. SmartCap, I'm just reading this off your website, one of your parts of your website there, Tim. SmartCap is a direct real estate investment firm operating in the Puget Sound area, one of the top real estate markets in the world, as we all know, we get to benefit from. They minimize investment risk by acquiring assets and at value-add pricing. They've completed over $235 million in total transactions by maintaining low debt-to-equity ratios, high operating buffers, and ensuring that their assets are strategically located in the Pacific Northwest for long-term growth and appreciation. Their track record for their entire portfolio, maybe you can update this today if I'm off, is over a 23% IRR paid to investors, net of fees and expenses. Pretty good stuff, guys, to jump in on that. I know I'm certainly a fan, and I have a huge capital gain potential out there for myself that actually with Goodman, that I don't have control over if they ever were to pull the trigger on selling that thing. Hopefully they wouldn't, because I imagine if it's hurting me that bad, it would crunch him too. But glad to know you guys, Tim. Let's get into it.
Sounds great. Let's do it.
Yeah. So Joe, kick us off with the numero uno there.
Heck yeah, Tim. The first question is always about getting to know our guests more. So if you can take us back in time and let us know how you grew up, where you grew up, and how that got you into this crazy world of real estate that we are in today.
Yeah, absolutely. I mean, I can go. I'll try to not take too much time on this, but I grew up in a really great family. I actually had a really good childhood. I had a really good life. I was born in Oregon, and I lived in a town called Drain, which is a town of about 1,000 people in Central Oregon, kind of right off, a little ways off I-5, headed towards the coast. Till I was around 11, then we moved up to Washington to another town of about 1,000 people called Onalaska, which is down out towards kind of White Pass area, south of kind of Chehalis, Centralia area, if you know where that is, south of Olympia. And I literally lived in that area, moved to Chehalis, and kind of just grew up. My dad was a carpenter. I grew up riding bicycles and playing, and started working in construction with him when I was younger, and kind of started that as my career, honestly. I had zero idea of what real estate or this big world of Seattle even really meant. And when I was probably 16, I graduated from high school. I actually never went to college. Everything I've kind of done has been just self-made or self-earned, if you will, a lot of hard work and dedication. I tore my ACL when I was 16. And why is that interesting at all? Well, it really started off kind of a change in my life. So I got into computer work at that point. I got into computers. I volunteered at a computer store, took a semester of assembly language programming, which is really kind of low-level nerdy stuff. And then when I was 17, moved to Vegas with my sister. So I worked at a local computer shop there, ended up working at a company doing network administration, and eventually found my way back to Seattle when I was about 20. So that kind of whole transition where like something in your life happens and it just changes your life was really pretty profound for me. When I got back to Seattle, I ended up going into a recruiter and getting hired at Microsoft when I was 20. So I kind of went into Microsoft. I didn't have necessarily an amazing skill set, quite frankly. I had done a lot of work, studied a lot, worked really hard to try to get some knowledge, and I went in and really offered to work for cheap. So I kind of begged my way into Microsoft, I say, in February of 2000. Went in for kind of a low price, told them I'd work my butt off, and did that. So I was there for 15 years. So I literally left Microsoft in 2014, probably 2 months before my 15-year anniversary. And in that process, I just kind of slowly got into real estate over time. So my wife and I, probably before the Great Recession, 2006, 2007 era, were looking at fix and flip type stuff. I always say I was a rich dad, poor dad kid, and that I read his book many times. I bought his board game and played it a lot, and just kind of had this fundamental idea of developing passive income, though I'm not so sure that term really is appropriate anymore. But I always loved that idea of passive income. So in 2007, my wife ended up starting a retail store in North Bend, Washington, which is another small town outside of kind of the Seattle area. And we suffered like everybody else that had retail through the Great Recession. In 2010, I had the opportunity, or we were at the end of our lease, and I wanted to close our store, and she really wanted to make it work. And so I said, okay, well, we need to move because this location is horrible. So we literally ended up moving just a couple blocks away, but to a much better location. And as part of that, that's how I entered into commercial real estate. So I had heard through a broker who never kind of came back and talked to us again, which was unfortunate for him, that there was this location and that they would potentially sell it. And so I waited for a couple of weeks to see if this guy would come back. He didn't. So I ended up calling a number on the side of this building, asking them what they were leasing for, just talking to them about general terms. And I asked them if they would sell, and they said yes. It wasn't actually listed for sale at the time, but it was an older couple that owned it. They agreed to sell it. I asked them if they would finance it, which was the real kicker, because I didn't really actually have enough money to buy it with a traditional loan. And they actually said yes to that as well. So to my shock, all of a sudden I was sitting in front of a $965,000 commercial building. I knew nothing about commercial real estate. This is in probably October, November of 2009. And I had a potential acquisition. So we agreed to a $65,000 down payment, which is about 7%. And we ended up closing January 1st of 2010. So that was my first foray into commercial real estate. And, you know, whenever I tell people about this story, my favorite comment is to show how little knowledge I actually had about commercial specifically, was the broker that was selling for the owners asked me, "Do you want an estoppel certificate?" And I was like, "What are those, and should I?" And his response was, "Can I introduce you to an attorney?" Which I graciously took that opportunity. I guess if I flip back for just a second, what gave me the courage to kind of move through that transaction was I worked at Microsoft. I was everything from a very low-level debugger, developer, and we did a lot of data analysis. So we were in this organization. We really built this organization inside of Windows that was large-scale data analytics back when it was just a job, not so much a thing like it is today. You know, big data is so powerful today, and back then it was kind of in its infancy. But we really used big data in that world to develop all these platforms inside of Microsoft. And so when I looked at this commercial real estate opportunity, I just built a data model. I didn't really know what a 10-year cash flow model looked like. I didn't really know how to value commercial real estate. I just really didn't have any fundamental knowledge at all. But when I built the data model, I looked at this building. It had 2 other tenants in it. And for the amount of money we were paying in rent, we would be profitable between her business and the building. So that made sense to me. So literally, I bought the building based on a cash flow model that said we would be cash flow positive, and it would allow us to build her business out and hopefully be successful, which her business went on to be quite successful, which we sold a couple of years ago. But that was really my introduction into commercial real estate. After I bought that building, I really looked at how do I replicate that in some way? What does this mean? Like I thought it was just like incredibly interesting, incredibly fun. And I was just super excited, right? I mean, I was so excited. Like, how did I just buy $1 million building with no knowledge of it?
Let's talk about that first building. So so it was fully occupied, or there was some vacancy when you bought it? Remind me again. Yeah. So it's a just under 7,000 square foot building, so quite small. And there were 2 tenants in it, and then there was about 2,200 square feet, 2,400 square feet of vacancy, and it was like gray shell vacancy. So my plan when I saw that was to move my wife's business in there. So we were the final tenant to bring it to 100% occupancy. Okay.
But we had to do heating, we had to do lighting, we had to do flooring, we had to build walls. I mean, it was like a full tenant improvement process, which I also knew nothing about. But it was, that kind of full process of buy the building, retrofit the building, get her business in there, get it operating, and then go from there.
Right. So let me ask you, how did you guys come up? Because these are things people are interested in and intimidated by. When you were working through the seller financing piece and nothing, who suggested the down payment or amount or the terms of the seller financing? Was it the seller saying, well, this is, what we can do? Or you said, how did that go down?
Yeah, I think that's actually a really great question. I think that's something that's pretty fundamental to who I am as a person. It was a little bit of both, but the original down payment, the asking, that was just me. The terms as far as I think I paid 6% interest. I think it was probably interest only for a couple of years. They really were looking at it as a yield thing for them. They had zero debt on it. So they were, they said, if I can sell this thing in 2010 and make 6% on my money on a $900,000 loan, that was attractive to them. But I think it was generally me asking. And that has been...
Is that because you had $65,000 and that's all you had? Or how did you know to ask for interest only? Because that's kind of a nice strategy there. Or did it come from your need based on, the building numbers that, paying interest only is what you needed to have happen in order to make the deal work? Or were you smart enough to try and get that term in there?
Yeah, I don't know that I was smart enough. That's a bold statement, but I think the reality is if I look back at who I am as a person, I've always been somebody to ask. So at Microsoft, my friends I would call some of the most senior developers in the company and just ask them, hey, how do you analyze this? How do you look at this? How do you investigate this issue? And they were always kind of a little bit shocked that I was always just willing to ask. And I think it's one of the most powerful things you can do for yourself as a person is ask. It's very intimidating to go ask these questions sometimes, but that's the only way you get an answer. And sometimes the answer you get is pretty shocking.
I have a little interjection story there about asking. You right, guys? There is no right answer, wrong answer when you're asking for something, especially in real estate. Because, when you're talking to these sellers, you don't know what motivates them. You have no idea. They might very well say yes to some of the most crazy favorable terms that you could put in front of them, right? So just ask for what you need. Don't try and figure out if that's good or bad for them. Let them figure that out.
Yeah, absolutely. If you look at this deal, for example, from their perspective, they have a tenant in there. We're moving in there. We are going to invest $75,000 into that space to get it up to condition, which is fundamental stuff: lighting, heating, cooling, flooring. These are all stuff that resell buildings in the future. And what's their risk profile? Well, they get the building back if I default. So for them, they look at it if he makes it, great. If he doesn't, great. It's really not. Right. It's really not that high risk for them from that perspective. So by asking, you're right. Their motivation was yield. They got the yield at low risk to them because they get the building back if I don't pay. So it really wasn't a high risk situation for them, in my opinion.
Right. And this goes for everything in your life, actually, everybody. You got to ask for stuff. You got to speak up. I can remember our mini backstory connection is I grew up working for a private real estate investment company called Goodman Real Estate, which touches you guys. I know you've had some mentors come out of there, Tim, as Joe and I had talked about. But I remember Absolutely. Back in the day, I started in the accounting department of a national property management company, which Goodman owned, right? Didn't know him at that time. And I was in the accounting department. I was an accounting major. And I somehow was nominated to go speak on behalf of the entire accounting department. Or else I said, I'll do it. We wanted a raise. Everybody felt like they were totally underpaid or whatever. So I went in and met with the CFO and I said, here's the deal. We need to get paid more. And I don't know what I said. And they said, okay, Julie, guess what? We'll give it to you, but nobody else. I'm like, what? They're like, yeah, we're going to give it to you and nobody else. Why is that? Because you're the one that came and, asked, basically.
Yeah.
It's that simple. Make sure you guys spend your life asking for what you want. Right. And then to work directly for him because of that. Within that following year, they hired me to be his, basically work directly for the main guy because of that. You never know what can happen.
I mean, I totally agree. I'll fast forward for a second before I come back to this, to a deal scenario that I hadn't really thought of, but it just popped back in my mind where I had owner financing on another building I bought in Tacoma. It was a retail strip center, well-off family. I assumed a loan. So I assumed an owner finance loan, bought the strip center. And then I got an unsolicited offer on the building. And it was actually a pretty attractive offer, but I wanted to see if I could make it more attractive. So I went back to the owners, who was a very well-off family. And I said, hey, if I can pay you off early, can I get a discount on my loan? Because I have another 5 years on my loan. And you had told me 6 months ago that you'd love to get paid off early. And I said, yeah, possibly. What do you want? And I said, $200,000. And they said, no, but we ended up settling on a $100,000 discount if I paid them off early.
There you go.
So I accepted the offer and made another $100,000 by paying them off early, simply again by asking, by having the forethought to say, hey, these people are motivated. I can potentially make more money if I go ask a question.
Right. Excellent
so,
stuff.
Yeah, you're right. I mean, it's all about having really the courage to sometimes ask a question and see what the answer is and not let kind of fear hold you back, if you will.
I think real estate investing in general is a courage game,
Yeah, absolutely.
And it takes a while to build up that courage, but the sooner you do it, just, surround yourself with mentors. I have noticed, because we are Seattle Investors Club, I do a lot of coaching. We have a lot of meetups and mastermind sessions that people's, and even in my own life with my own kind of, specialty teams or whatever I'm doing, I've noticed that when we have a group, rather than me kind of off doing my own thing, the power of the group knowledge just builds confidence. So make sure you guys are out there joining your local real estate investment club, that you're out there seeking mentors that you meet with regularly to give you the courage that it takes to just move forward in this business. But let's get to it today. Let's go back and talk a little bit more. So keep us on the track of you bought a couple of buildings. You still aren't with Joe yet. How'd that all come down?
Yeah, I literally, I went on Amazon back then, bought probably 10 books and learned the fundamentals of real estate a little bit. I say a little bit, which is the truth, and started syndicating. I called my attorney, same one, said, let's go syndicate some deals, negotiated a flat rate fee, kind of got my fee structures in place. And I did my first deal in syndication in 2011, which is just under $1 million.
And were you working at Microsoft at that point?
Yeah, I was. So I maintained Microsoft through the end of 2014, actually. So I syndicated a deal there through people I knew at work. I literally went in and was like, hey, I own this building. If I could do it again, would you invest with me? And I had people say yes, and I think as I was reading those books, the like OPM, other people's money, was always really kind of ugly to me. But when I changed my perspective and realized that there's investors out there that want to put money into deals, that was really kind of transformational mentally for me. Realizing that I could go fundamentally create a platform for people to put money into that benefited them was really interesting and exciting. And so I started doing that. In 2011, I did a deal. 12, I did a deal. Maybe 2 deals in 2012. I think I had done 4 or 5 deals before I met Joe.
And these were all like office or what? Retail?
No, they were actually all retail strip centers. So I did like places like Puyallup, Tacoma, Squim, which is like in the middle of nowhere in Washington.
Why did you pick those areas? Just curious, because I have also owned some retail strip centers again with Goodman, and those were, those can be squirrely, where there's low rent out there and
super squirrely. Ignorance and ignorance maybe. The reality is if I'd started in multifamily, I'd be far wealthier than I am today, but I bought a retail building to move my wife's business into. And so I had this concept of retail, like that's kind of all I knew. And so I jumped into retail, and I looked at it as like a little bit of the path less traveled. Everybody was buying multifamily, so I went into retail. It allowed me to move slower and still be successful. And when I say slower, there was less competition on every deal. So
Right.
it felt a little bit easier, I think, even though the reality is I probably should have just jumped into multifamily. But
what's interesting is that most people still avoid retail, it seems like.
So do we.
Right. I mean, so somebody, if you're listening out there, go be a retail genius. Actually, Sean Katona, one of our buddies, Joe, you can link his podcast in here too, as well as Joe Allis's past podcast, which I think is number 65. There's an opportunity there because it is squirrely. It can be.
It's
squirrely.
a counterplay. Absolutely. Yeah, absolutely. I agree. I think
right there, guys.
I think if somebody has courage to go understand it and go find the right deals, there's a lot of value to be had there. So the service industry will live, so retail will continue to exist. But so then I met
changes too, right? There's something going on there probably.
Yeah, absolutely. So then 2013, I decided I really wanted a business partner. I knew I wanted to do this full time. And so I was kind of actively looking. There was another guy that we were talking to who actually was in the first deal. Joe, his name's Kevin. Joe, Kevin, and I did together. And, I think we raised $7 million for that deal or something. And Joe and I decided 3 was a lot and that we were better off together. I mean, we have really opposite personality types. He's much more conservative. He's very, very, we're both very numbers driven and both very data driven, but he's even more so than I am. So he's kind of the guy that builds all our models and does that. And I was the guy that was more big picture, out driving acquisitions. What are we looking at next? How do we grow? Taking on that role. And we just fit really nicely. So as we started talking, we decided to launch SmartCap. We launched SmartCap in April of 2014. We both gave notice shortly thereafter, but I had told Microsoft we were in the middle of a ship cycle, so I told them that I would give them till the end of the year if they wanted it, and they took it. And then we both went full time, and we were, kind of off to the races since then. We've done over 200 million in transactions. We're mostly office and industrial. Actually, we're exclusively office and industrial at this point, though that's possibly changing in the future, which I'll tell you about later. Mm-hmm. But that's what we do right now is we look at really high quality, still value add office. So we're, Bellevue, Kirkland, Redmond type locations. And then we're building industrial. So we landed 100,000 feet in July. We're under contract or under construction on another 100,000 feet right now. And we're trying to get enough land to build another 300,000 or 400,000 feet over the next year or two.
And where's this going to be? Are you focusing on servicing the
all opportunity zones?
Yeah. Okay.
Yep. Yeah. All in Arlington, Marysville market right now. So our first building was in an opportunity zone, believe it or not, but it was pre-opportunity zone when we started that development. And so when the opportunity zones came out, we were just super early in the let's go do this thing because we're already building in this area and we're already being successful. So why wouldn't we build more? So we built an opportunity zone fund really quite early and successfully raised money for the project we're building right now. So our first fund was 10 million. We're building over 2 phases. So we're building 100,000 feet right now. Once that's stabilized, we'll build the second phase, which is 130,000 feet approximately. And then we have an opportunity zone fund open right now to go build our second phase, which that'll probably be anywhere from a $10 to $18 million fund, just based on equity that we need for the final project.
Well, let's back that up for a minute on how this all works. So you guys both have value add non-opportunity zone funds as well as opportunity zone.
Yeah, that's correct. I mean, a majority of our portfolio has been not opportunity zone related.
Right.
Yeah, so we did $50 million in office buildings last May. We launched another development, so we had kind of a $70 million May last year, and we looked at just a significant. I mean, we probably looked at 20 off-market deals that were all office in the Redmond, Bellevue, I-90 kind of area, Seattle last year. So really, our 2 focuses are office, which is all non-opportunity zone, and then development, which is both opportunity zone and non-opportunity zone, quite frankly.
So how do, if something's opportunity zone versus non-opportunity zone, when you're approaching the deal, how does it look different as far as, in regards to getting it started, finding the deal to buy, raising the capital, then closing? So I guess what I'm saying is on the opportunity zone deals, I don't know, on non-opportunity zone deals might look like you get a deal, you get it under contract, maybe, and then you raise the funds after you've got it secured? Or do you raise the funds first for your non-opportunity zone deals?
We do kind of both. So we have funds. So we have a blind pool fund, if you will, that we just launched our third blind pool fund right now, actually, where we pre-raise and then go buy office buildings into that fund.
And who's putting money in those funds? And once the money's in that blind fund where you pre-raise, does everybody agree it's just parked there, or it's not earning anything, or what's the story on that?
Yeah, so a lot of the money is tech. So, I mean, Joe and I were both tech. I was Microsoft, he was Microsoft, and he went to a couple other companies. So we have pretty good reaches into Amazon, Salesforce, Microsoft, Expedia, et cetera. So all the big tech companies around here, we've kind of wormed our way into, if you will. So most of that money is just literally private tech investors that want to diversify their portfolios. And the way we actually utilize the fund is we require a 10% deposit that we calculate a cumulative pref on all the money that we've collected. So we take 10% as a deposit to ensure that they will fund when we need the money.
Yep.
And then when we find a deal, we do a capital call. And the capital call is not above their commitment. So if you've committed $100,000, we can't call you above $100,000. But that allows us to have that assurance that when we go under contract on a deal, we have the equity in place. And then we have some larger investors that simply will not invest in a fund. And so we sidecar those investors into a deal. So we'll have a fund own half of a building and a sidecar investment owns half of the building, for example. And SmartCap is the managing member of both of those entities. So we still control it. But it allows us to...
They're partners in the deal, the fund and the sidecar.
I didn't hear you there. Sorry, your phone was kind of moving.
The fund and the sidecar of the investors are partners in the project.
Yeah, they just JV, joint venture, those two together, and we still manage it. So our funds are fully discretionary, meaning we have total control. So we can invest in what we want to invest in. Obviously, we set guidelines, but we have control of that, and then we just JV our larger investors into those deals.
So the ones that are parking their money in the fund, the blind fund, while it sits there, did you say they're earning a return, a pref?
Yes.
While it sits?
Yeah, so we do a 8% cumulative pref. Like our model, our waterfall, if that's what you call it, is an 8% cumulative pref. Once we return that, we return equity. And once we return equity, if you invest over $500,000, it's an 80-20 split, 20% going to the sponsor or us. And if you invest under $500,000, it's a 70-30 split with 30% going to the sponsor.
Interesting. That's cool. So,
yeah.
And then when do you start paying that? Obviously, you don't start paying on that until you've got an asset that's producing some funds. And then I imagine you probably build that pref into your raise, I guess I'll say?
We don't build the pref into our raise. So the way and you're right, we don't pay prefs until we acquire assets, and we don't guarantee 8% a year, but it's cumulative, meaning we back owe it. So the idea, like imagine we do a value add deal. Generally, it takes 2 or 3 years to get your cash flow on value add projects up to that kind of 6 or 8% annualized. And so we're accumulating money that we owe back to our investors. So if we paid them 0 over 2 years, we would owe them 16% before we could start returning equity. So the idea is they accumulate that money. We're not necessarily paying it out. We do quarterly distributions as soon as we have an asset that can provide distributions. So we do quarterly investment summaries with full building valuations and distributions. And we do monthly updates as well. But that is our kind of distribution mechanism, is that quarterly basis. And then once we've caught up on that pref, then we return equity next, and then we have splits on additional cash.
So does that look different from a value add fund to an OZ fund?
Not for us.
Yeah.
No.
So I mean, right now we're talking about a value add fund that you've got a blind pool, plus, you got this sidecar investors you can tap onto. But how does that look different if it's an OZ project, meaning people need to, place their money, and then it's, they're doing it for tax advantage reasons, and then you're under pressure. You damn well better buy something,
Yeah, you have some time. So like, for example, right now, the fund that we have open, we launched it in 2019 so that people could get the full 15% tax adjustment. So the basis adjustment, knowing that we weren't going to close until probably July of this year. So they gained 5%. And we have
to get you to that full 15% on the opportunity zone, tax advantage there starts from the date you put your money in the fund, not from the date that a building or the project gets purchased.
Correct.
That's huge, right? Yeah.
Yeah. Yeah. I mean, it is and it isn't. I mean, I think people get really caught up on that 10 and 15%, which if you look at the 5% overall, it's really negligible on the total return profile. The real reason opportunity zone funds are valuable, I'll get back to our fund model and what we're doing in a second, but the real value there is your equity multiplier is really powerful. So when you don't pay 30% on tax or 40% on tax, whatever it is, or 20 even, if it's long-term, that you're getting an equity multiplier. So if you're getting a 2.5 to 3x equity multiplier on, call it $20,000 or $30,000 even, right, that's a lot of money that you don't get otherwise. So that's a really big piece of the value proposition. And then really the tax abatement for long-term capital gains at sale is another really big piece. So when you look at if you invest in 2020, for example, you're only going to get the 10% step up in basis. You can no longer get the 15. It's so negligible on the return profile that investors shouldn't really look at that as a deciding factor. They should be looking at the deal. They should be looking at the sponsor. They should be looking at what they're getting into and not stress so much about the loss of 5%. It's still a fantastic investment, in my opinion.
Right.
When you do the math,
we're talking about why the 15% is no longer available is because you have to pay based on I assume what are the current rules still, December 31st, 2026.
Correct.
You've got to pay up on the capital gains that you deferred, I guess I'll say.
Yeah, and you no longer have 7 years. So it's a 7-year requirement to get that additional 5% step up in your basis, whereas to get the 10% step up in your basis is 5 years. So you still have time to get that. So if you go back real quick to our fund, we launched that kind of blind, but not really. So we went out to our investors and said, hey, we're looking at these two deals, and we're very confident we can land this one over here. And this one over here, which was fee simple, so one's a ground lease, one's fee simple. The fee simple one, we're not sure yet. But if we can land the fee simple, we're going to go that direction as long as we can get the pricing right. Otherwise, we're going to go over here and build on this ground lease dirt that's fantastically located. And we got all the kind of, there's a bunch of complexity with ground leases that you really need to dive into if you ever want to go down that route. But if you get them right, it's not a real big issue on your valuation. So it wasn't totally blind. It was like, here's the two options that we're going after. And that got our investors comfortable enough to invest last year that wanted to achieve that full 15% step up in their basis. So that's kind of how we approached that opportunity zone fund specifically.
Right. So does it change every year going forward because of that 2026 mark?
It doesn't for a little while. Then eventually you'll lose the 10% step up in basis. So it kind of whittles away at the value proposition. But again, in my opinion, it's not that significant. I mean, the step up in basis is nice, but it's not the real value. The real value you get is your equity multiplier and tax abatement. Eventually, you're going to have to pay tax fairly quickly, and so that might impact you based on if it's 2025 and you have to pay at the end of 26, you need to make sure you have cash available. The new regulations that came out do allow us to refinance and return equity, essentially. So that's a really nice capability.
Helps. But it's to rely on it, right? I mean,
you can't really rely on it. There's definitely a risk of relying on it. But between the way non-recourse tax allocations work, it allows you to have a positive capital account down to your investors. So, because when you invest in an opportunity zone, so step back for a second, when you invest in an opportunity zone because you haven't paid taxes, you actually have a zero basis capital account. So you don't have a capital account.
Can you take us through like just a standard deal real quick, just kind of the basics of what we're talking about here, because we're talking a little bit advanced. I just want to wind it down for 1 second in regards to
absolutely.
The whole opportunity zone, how it works, what the mechanics of an opportunity zone are. Just real quick, can you run us through that?
It's pretty simple at a high level. So you sell an investment, whether it's art, a house, a building, stock, doesn't really matter. And you get capital gain. Long or short term, it also doesn't matter. You can invest that money into an opportunity zone within 180 days of receiving the tax. There's a little bit of nuance with that we can come back to.
Can you actually receive the funds? You receive the funds in this case, unlike a 1031 where you never receive the funds.
Yeah, you receive the funds and you just transfer them over to the fund manager essentially. And there's a form that you fill out with the IRS. The fund manager also fills out various securities forms and IRS forms to kind of cross-collaborate those things. It's quite simple. They've really done a great job in making this easy, which was one of the big goals. So you can touch the money, you can then go analyze all the funds that you want to invest in, choose a fund that you want to invest in, give them your money as long as it's within the time frame, and then you just report that to the IRS, and it's quite simple.
And when you report, tell us then again the time frames.
Sorry, what was the question?
Tell us the time frames again.
So you have 180 days from receiving the gain. So the two simple examples, if it's stock sale, you receive the gain immediately. If it is a company, for example, a partnership, then technically you would not receive the funds until as late as 12/31 of that particular year. And the reason for that is you could do a 1031, you could, there's various ways to kind of avoid that tax so that you don't technically receive it until the end of the year. And that allows you to kind of manipulate your timeframes a little bit. But the key there is making sure that you honestly work with your CPA, understand the laws, and make sure that you're investing within the timeframes, and you can avoid paying tax on that money until 12/31/26. 12/31/26 comes, you have to pay the money. But if you have been invested from today onward, you get a 10% step up in your basis. So that means if you're basically paying 10% less in tax is the easy way to look at that. And then if the fund manager maintains that asset, in other words, they hold that asset for 10 years, past fund collection, and then they sell it over that 10-year period, then your long-term capital gains as an investor is abated. So you do not pay tax on that long-term capital gain.
On the growth.
Yes.
Absolutely. But you are paying it on your original capital gain that you
pay your original capital gain on 12/31/26, and that is a hard line for everybody right now. There's no getting around that.
But then if the fund holds the property and sells it after 10 years, any growth you've had while you've been invested in it is tax-free.
That's correct. Right. The other great thing about this from a tax advantage scenario is that you can use accelerated depreciation to increase your expenses essentially annually, increase your depreciation. That depreciation at sale is a capital gain, and that appreciation is also abated. So by using accelerated depreciation on these assets, or cost segregation is what it's called really, you go do cost segregation analysis on this and then accelerate your depreciation, you actually are able to reduce your annual regular income tax as well. So when real estate generates income on a yearly basis from leases and just general revenue, that gets distributed back to the investors as ordinary income. And so the other tax advantage you get here is you gain tax advantage through accelerated depreciation, which reduces your annual ordinary income as well. So that's really a fantastic way to gain a tax advantage on a yearly basis as you're owning this asset. So it's really,
in a nutshell, you can collect cash flow without any tax that you have to pay on it because you have a tax loss due to depreciation on paper, making it look like there's a loss.
yeah, you might not quite get a loss. I mean, that might be a bold statement, but you're certainly reducing it and potentially getting a loss. So it depends on the individual asset.
When it sells later, you have to recapture that depreciation that you were getting to write off all those years as part of the tax calculations, right? That's what we're talking about. And what we're saying is, since that's categorized as a capital gain at that time, you have the opportunity to do this again.
Yeah, all long-term capital gains at sale are essentially abated. And so the most recent regulations that came out confirmed that accelerated depreciation would also be abated. So you're not going to pay tax on that. So it's really a fantastic investment. I mean, as long as the underlying deal is good, it really adds a lot of value to the investment.
I think when Joe Allis and I were talking last time, we called it the Holy Grail, of the possibility of this, depreciation play. So what happens is when you sell a building, you have your gain from the growth of your investment that you get taxed on, but you also get taxed as two parts of tax, guys, a double whammy, right? You get taxed on the growth since you owned it of any gain there, and you get taxed on the depreciation recapture from writing off depreciation all the years that you owned it. You got to pay a capital gains tax calculation on that when you go to sell it. But what we're talking about, is that...
Which is typically 25%, by the way. So it's that recapture is a 25% tax rate. So it's actually higher than your long-term capital gain rate.
Right. So typically, if you didn't have the opportunity of an OZ type of fund or maybe a 1031 situation, I don't know. In a 1031, can you get to include that in your exchange, right? You that part of the gain related to depreciation, correct?
Yes, you do, but eventually it all catches up, right? That's the delta here is in a 1031, you have an original basis, but unless you die, that's true.
Right. I think we were talking about how 1031 is, for people who are looking to never, sell anything until they die and pass on generational wealth, that's what that is there for. But why, and I guess that the piece of that means that you're not paying that tax at 12/31/2026, right? That avoids that with a 1031, but you have to literally exchange until you die, or hold
That's
forever.
Correct.
Right? Versus
and you have to select 3 properties, and if those 3, it's just 1031s are much more complicated and limiting, right? So from that perspective, this opens up your ability to invest in a much wider platform of opportunities. It doesn't force your hand to make a decision very, very quickly. It doesn't force your hand in pre-selecting 2 or 3 funds. So you can really go out and say, hey, I like this sponsor. I like these deals. I like this thing. You can go really analyze the deals and the sponsors that you're really kind of getting into a partnership with, because these things are 10 years, or more, 10, 12, 15 years. You really want to know who you're working with. You really want to know, how do they communicate? How do they provide financials? How are they valuing that asset? To me, when we built SmartCap, I said we wanted to be the mini Fidelity of syndications. And what I meant by that was, I never want you to have to call me to know your net worth. That just seems backwards. And for some reason, nobody in the real estate industry can understand that. But we value our assets quarterly. We tell people what share prices are quarterly. So it's really important when you're going through, whether it's a 1031, I mean, you own it yourself, but in these cases, the time frames really allow you a lot more opportunity to go analyze who you're going to be working with and what the deals are. And that's very attractive for people.
Absolutely.
Hey guys, it's Julie here with a quick break from the show to discuss an opportunity some of you may have interest in, which is to work more closely with me. On almost a daily basis, I get calls from investors and brokers, both new and experienced, asking me for guidance or advice. I love helping you guys out, and it keeps me on my toes too. So with that said, I wanted to let you know that I have a private broker coaching community called the VIP Education Community. And the best part is that it's 100% free. That's right, it's free to join. So whether you're a traditional broker or a broker investor, my VIP education community offers personalized one-on-one coaching from not just me, but also from my experienced broker friends with expertise in all disciplines of real estate and real estate investing. We'll teach and share our modern marketing strategies, our tech and lead generation resources, plus teach you how to identify or offer up opportunities for yourself or for your clients using techniques such as seller financing, lease options, land entitlement deals, BRRRR investing, flipping, multifamily or commercial coaching, whatever you like. We've got it all covered for you. The future of real estate is changing fast, and to stay in the game, it's time to learn about all the options you can offer your buyer and seller clients, as well as, if you want, learn how to use those skills to grow your own real estate portfolio. If you'd like more details about joining my VIP education community, reach out to me at julie@seattleinvestorsclub.com or text me at 206-910-2985 or just send me a Facebook message. My new favorite phrase is community equals confidence. So let's navigate the future of real estate together. Now, back to the show.
Maybe not the big part, but some discount on your capital gains tax that's due in 2026, but we're not focused on that as any decision-making factor, really, right? But the real meat then is getting into the OZ fund where you're going to hold it for 10 years. So you have the opportunity to get that tax-free growth of that investment, for this, as we're talking about the equity multiplier that comes with that, right?
Absolutely.
Are you required to sell it after the 10 years?
No, you're required to sell it by, honestly, I forget the exact date. It's like 42 or something like that, to get the actual treatment. So there is an end date associated with it, but it's quite a ways out there. So there's no 10-year hard timeline that you just have to sell it. So in the case you're in a bad market, that's kind of why I said, is it 10 years? Is it 12 years? Is it 14 years? You don't really know. There's a market condition associated with it. And that's why I say, make sure you know who you're getting involved with, who your partnership is going to be, because it's a long-term partnership. It's not a 3 to 5 year deal where you get to exit. If you're frustrated with a sponsor, that's going to be a long engagement.
Right. Exactly. But the key part that everybody needs to keep in mind is that, let's say you were to sell something, your stocks, property, whatever it is, that you have to pay tax on that capital gain from that sale December 31st, 2026. And so, how are people dealing with that in your world?
We make it really clear to our investors that we are not their tax consultants. I know.
How are you dealing with it personally?
Just tax planning. I do annual tax planning personally, and I have forecasted out tax planning. The reality is our goal with our investors is to be able to refinance and return them equity so that they can pay those taxes at that time or potentially pay them back earlier. But we just send reminders to people that, hey, these are the deadlines. You need to remember that you need to have your tax planning in place. You need to work with your CPA to make sure that you're following the rules. We simplify it in some ways. Like, it can get really complicated if you take non-capital gain funds from an investor and capital gains funds from an investor because they're treated differently. So they essentially have two capital accounts. And so then that can really, I think that can confuse a lot of people. So we just will not take anything but actual capital gain money from an investor. Now, I mean, we trust them that they're telling us that, but then we treat it as a single capital account for them. So that's, there's a little bit of nuance like that you really want to make sure. The easiest way to control it is to only invest capital gain and don't mix your investment. You certainly can. Just make sure that you're paying close attention to that and you know your basis for both of those investments, et cetera, because it is more complicated then.
Do you, do you have people that want to invest in those deals, like you said, I guess, that are not capital gains money, they're not mixing it. They just want to use, other money outside of capital gains money because it's a good deal.
Yeah, we don't, we just say we have other funds.
Okay.
Personally.
I got
yeah,
you.
we have these value add funds. We're also building, we'll be building in non-industrial or non-opportunity zone markets. So we're like, hey, if you're trying to get into industrial development, if that's your goal and you have money that you want to put into industrial development, great. We have an opportunity. It's just simply easier to manage if we don't mix those funds. So we just don't mix them.
So have there been any updates in the last year to any of the gray area laws? We talked about the 2026 thing. That sounds like it's still in stone. I guess the update is that you guys confirm that you are able to refinance during the hold period.
Yeah,
right?
That's a big one. I think the accelerated depreciation that we discussed is a really big one. Another interesting one, and this is going to go into the nuance of tax law. So the start date of that 180 days until you can invest, there was a lot of confusion around that in 2019. Because technically as a partnership, you didn't receive the gain until 12/31, 2019. You had risk of pre-investing that money. So if you invested it, let's say you sold an asset in September and you invested it in October, there was, the way the laws were written, your 180-day clock may not have started yet. And so there was a lot of confusion around when does that clock start? Can we start it immediately if we want to, or do we actually have to wait until 12/31? And so for us to kind of offset that, we literally invested our money on 12/31, 2019, because the regulations weren't quite clear, although they came out right before that and they made it clear. But that was a concern. That got changed. So you can invest, if you sell a partnership, you can invest that money essentially immediately without the worry of that 180-day clock starting. Another interesting one for the sponsors out there, which most sponsors probably know this, but the carried interest, so in other words, our splits or our profit at sale, is not tax-free. So we don't get the luxury of creating these investments, making everybody a bunch of money, and then getting our money tax-free as well. So that's something the IRS came back and we're very explicit about. So as a sponsor, you'll be paying tax regardless. So a little bit of a bummer.
As part of the sponsor, can you, as an individual, can you, Tim Shoultz individual invest in the deal outside of your sponsorship role?
Yes. So my personal investments that I do, we do invest in all our own deals. That is just like any other investor. I sign a subscription agreement. I'm regulated by the exact same rules and laws as everyone else. It's literally just the money we get back as a sponsor for our efforts. And that's called a carried interest. And that carried interest money specifically is not treated in the same way, but any direct investment is treated in the same way.
How about, I think there was one of the gray areas was that when you go to sell down the road after the 10 years that you have to sell the entire fund. So you guys were doing like single asset funds. So you would be able to sell. Is that still the same?
No, that's not an issue at this point. So you're able to sell individual assets and not have that kind of complexity, which everybody expected that. I mean, the great thing about this program, which I've always thought, at least in my opinion, is it did receive really good bipartisan support. I mean, there's definitely conversation around certain tracts being undesignated, if you will. So like think about South Seattle or Pearl District in Portland. These are not low-income tracts, but the way the low-income tracts were created was from 2010 census data. And so it was skewed in certain situations. Outside of that, it's really had good bipartisan support. And it felt like the IRS and Treasury, when they were coming out with laws, were being very reasonable. They were listening to the investors and the people around that had kind of, I guess, deep understanding of this. And when the final regulations have been coming out, they've been very reasonable, in my opinion. So I think it's overall quite a positive outcome.
Anything that's going to go down in regards to that?
Personally, no. I don't think it's going to be, not where we're investing. So we're investing in markets that are designated as low income and really are. So I could see some potential problems with these bigger investments that are in really prime locations and they're building super high-end multifamily and things like that. I could imagine some difficulties with some of those along the way, but I don't see it as an issue where we're at. The other thing I always tell people is like, you should be investing in this as an investment first and tax second. So if it's not a good deal to begin with, you know, if you're not getting a good equity multiplier and a good IRR out of the deal to start with, then you shouldn't be investing in it anyway. So, you know, from a safety standpoint, if you are investing in those prime locations and high-end multifamily or big office buildings or whatever is occurring, then you need to make sure it's a good deal to begin with. And if the tax treatment maintains or remains over the course of the 10 years, then great. But I think in these lower income areas, like where we're actually building, it's quite low risk, in my opinion.
Right. And is the law still the same in regards to having 31 months to place the funds, the OZ funds?
Yeah. So for your safe harbor investments, none of that's changed. So you still have from the qualified opportunity fund, we distribute 90% of the cash down to a qualified opportunity zone business, and then we're able to invest that. The other part that there was clarity on is there's a lot of startup costs, if you will. So think about private placement cost and diligence and legal documents and all these various things that are sometimes capitalized or are always capitalized. Those costs are not going against you from a 90% testing standpoint. So those, if you're holding back certain costs, those are allowed to be considered expenses or actually paid out money towards the investment. So there was clarity on how that money is treated, which is great because there was a lot of concern around how much do I really need to put down to the qualified opportunity zone business and what counts and what doesn't. Right. So those kind of startup costs were also clarified, which is great.
Let me clarify one thing to make sure I got this right. You know, in a value add deal, just a traditional deal, we'll call it, when one of the investors gets a cash flow distribution, that is not taxed as ordinary income at that time. But in a OZ deal, if you get a cash flow distribution, it's considered ordinary income because it's like a business operating business distribution. Is that
no? Both are. So it's a little bit more nuanced than that, but both are ordinary income. So I always tell people cash flow and taxes are not tightly coupled, though they feel like it in a lot of cases. You can have cash flow with depreciation and get no tax consequence, for example, or you could have a real estate property that produces a lot of income and we hold that income back to like re-tenant someone. Well, you can, you know, some of that re-tenant cost might have been capitalized, for example, so you can get income tax or you can get tax that flows through without any distribution at all. So both of those scenarios can occur where you can receive money that's not taxable or you can get taxed with no distribution. But in the event that it comes from ordinary operating income or ordinary operating business, whether it's Oz or just direct real estate, that is ordinary income in both cases.
Yes. We need our CPAs to noodle on all that stuff for us. It's complicated yet not complicated.
If you break it down, like your annual income that comes through from the business is ordinary income, and when you sell it, it's long-term capital gains. You can offset that with depreciation and expenses, but if it has to flow through, it flows through.
Right on. Have you noticed any of your comps being affected by, is anybody paying a higher price for OZ properties and opportunities, and that's skewing comps at all yet? We had talked about that earlier with Joe.
Yeah, no, not in our markets. So South Seattle it's a really funny thing. Everybody thought, I think when we first got into opportunity zones, and everybody was like, oh, opportunity zones, and everybody was like super hyped about it, which it's calmed down. Everybody saw gold in their eyes, but I don't think it really changed comps. I mean, everybody was looking at South Seattle like that was happening, but at the end of the day, South Seattle has seen multi-level industrial at this point. It's not proven yet, except for there's a Prologis building that kind of is, but there's a couple developers down there building multi-level industrial. They're not Oz projects, even though they could be. And that has driven prices so high that, your dirt profile in South Seattle right now is $120 a foot, and it's still zoned industrial. So the only thing you can build is multi-level industrial. Right. And so like in markets like Arlington and Marysville and places like that, you've seen a lot of growth, and I think that's been spurred by, to some degree, opportunity zones. So like groups like us are up there building, another couple groups are up there building. But it's also been, there's so little land left in places like Kent Valley and Everett that you're seeing push to, on the south end, pretty far out markets like Lacey and Frederickson's, and farther than that. And on the north end, you're starting to see it push into Arlington and Marysville. So that's pushing prices. But how much of that is attributed to Oz versus just market fundamentals? I think It's more market fundamentals.
Are you seeing any absorption issues then with people paying attention to those markets now?
Our first development, we landed last July, and we were 100% occupied within about 2 or 3 months. Our current project, we just tilted walls on one of the two 50,000-foot buildings. We'll tilt walls on the other in hopefully another week or so. That we're about 20% occupied right now. So we're not really worried about absorption yet. There's been a lot of groups that have come up as kind of owner users into that market as well. So there's been a lot of demand, but it's not all tenants moving. But we haven't seen any issues. I mean, vacancy in Everett is sub 3% probably for anything reasonable. So there's just not a lot of product. There's not a lot of places. So it's just a really tight market. Everybody's a little bit worried about Boeing right now in our market with manufacturing and whatnot, but there's been a couple companies that have had layoffs in the area, but it hasn't been a big impact yet.
Awesome. Well, tell us about SmartCap Construction. Yeah,
I mean, we launched SmartCap Construction last year, and we if you look at SmartCap, SmartCap Construction is actually affiliated. But SmartCap, we have asset management, we have property management. Those are kind of the two main businesses inside of SmartCap. Obviously acquisitions, but that's part of asset management.
Why did you guys start that? Just as a complementary business, it just made sense?
Yeah, we had these kind of income streams, and really if you look at property management as an example, property management we brought in-house because we felt like we could control it better. Third-party property managers have so many projects going on. They will have a property manager with 20, 25 properties under their belt in some cases when you're looking at these mid-sized properties. So you just don't get the quality that you expect.
That's a question when you guys are looking at other OZ funds and you're analyzing your due diligence, who does in-house management and who doesn't, Yeah,
and I mean, it can be a pro or a con, I guess, in some cases. For us, it's great. We don't have, our property managers have small portfolios. We manage to a very high quality level. And kind of construction was the same thing for us. We were sitting on a 12-acre parcel. So if you look at those two buildings, that's about $22 million in revenue. across just those 2 buildings. We're trying right now to secure another 15 to 20 acres, which will be another 35 million in revenue. We own a lot of office buildings. So we're always doing tenant improvements. We're doing lobby upgrades. Every time we buy something, we go renovate it. So we just had a lot of revenue opportunity in front of us. And I had relationships in the construction industry, mostly from groups that worked for us, quite frankly. And so I brought a partner on. His name's Tyson. We brought a partner into Smart Cap Construction. He is kind of the operational guy, if you will. He's been running construction companies and divisions for 25, 30 years. And Joe and I are good at running businesses. So we just kind of married the two and took off. So we're running our own development projects right now. We're doing a bunch of third-party work. We just got a bunch of medical work into our pipeline that we've been awarded.
Wow. Okay. So you guys are doing third-party work. That's cool.
Yeah, we're off to the races. I mean,
you guys are ambitious. My God.
We are. Sometimes you see opportunities and you jump.
Well, let's talk about how to get these deals real quick as we get winded down here in the next, 5 to 10 minutes. So one of the things you and I wanted to talk about today was, transitioning from buying from a mom and pop situation to institutional type of transactions and the challenges related to that. So give us your insight on that.
Yeah, I mean, I think if you go back to kind of the strategy that I had developed over the years, we started off in a pretty low quality retail strip, and I know I didn't want to be there forever, but it was a matter of being able to raise enough money to kind of buy higher quality assets. To buy a $30 million asset's a very different thing to buy a $965,000 building, which was my first building. And so we kind of grew that strategy over time of what we could raise and what we could buy against, and with the idea of getting into more of an institutional platform. And it took a lot of time. There were a lot of challenges associated, especially with expectations.
What does that mean, though? So for the listeners, what does that mean, getting into an institutional platform?
It's quality, it's location, and it's size, in my mind. So when you get into there's an area just outside of Bellevue called the 520 corridor, and we bought a $32 million office building there in May. It's a really tight, sought after market. Most of your buildings there are kind of 30, 40, 50 million plus. They're really well located suburban office, and they're good quality. So you're going to push rents. You're going to grow those markets. So institutions really shy away from risk, and risk is associated with quality and location, quite frankly. So as we were growing our platform from retail strip centers and secondary locations, we bought a couple buildings in near Payne Field, which are actually doing phenomenally well. But they're just kind of outside the mark. They're a great quality comparable to an institutional asset. So they're $27 million for 2 deals. They're in the same kind of business complex. We bought those within about, I think, 9 months of each other. And that kind of continued to allow us to build into these institutional markets, if you will. So Bellevue, Redmond, Kirkland, kind of these core, we still had a suburban focus, but these core suburban markets. And really the challenges associated with that are immense. I mean, your competition is really fierce. When you're going up against a company that can write a check, an example of, if you go back to 2013-14 era, we were working with a broker who was just write a lot of offers. He's like, nobody cares. Just throw paper at a wall and we'll see what sticks. And so we're like, okay, I guess that's what you do. Well, that turned out to be really bad for us. Our reputation took a hit. We didn't really know it until somebody told us. They're like, hey, you guys kind of have a bad reputation in the market for just writing offers and not performing well. And that really struck me at that time, as I was like, oh, okay, we're coming out of a recession. It might have been okay for a minute, but not very long. And so getting to the point where your reputation is just squeaky clean, if you write an offer, you're going to close at that price. You understand how to do diligence on a property. You understand if you buy a circa 1980s building with hydronic loops in it that they're probably going to need replaced, and you better write that into your offer price. It's that type of understanding of what the institutions expect And then it's also really interesting as you go from a mom and pop buyer, you just kind of demand everything. You're like, I want all your P&L statements on a monthly basis in cash form, and I want tenant ledgers, and I want your BOMAs, and I want this and this and this and this, and your laundry list of expectations is just super high. We've always had that.
Of the seller to provide you with their information.
Right. And then you go to an institution and you tell them that, and they just say no. They're like, I'll give you accrual-based statements. I'll give you maybe can convince them to give you a balance sheet so you can actually cross-collateralize some of this stuff. Your ability to get a survey or a BOMA are oftentimes impossible. They just protect their information, and they expect you to understand that that's how the world works. And if you can't figure it out, then they'll sell it to somebody else.
Basically, underwrite your own shit, and if you know what you're doing, it won't be a problem for you, or go away. And
it's super daunting. I mean, it's just like the emotional impact of that when you're not expecting it, and you're like already freaked out about trying to close a $25 or $30 million deal for the first time, and then they just tell you no to everything. You just kind of sometimes sit at your monitor looking at it shell-shocked, like, well, what do I do? And I think the way we got over that was we worked with the brokerage community to understand those expectations better. So, I mean, it happened to us, and I was like, Jesus, what do I do? Right? I mean, this is really tough. And so I went to one of the brokers that I worked with, and we kind of got into a little bit of a heated discussion. But my final comment to him was like, hey, I'm coming to you as a small guy in this world. You've done hundreds of institutional sales. Help me understand their expectations. Help me build a platform to be successful. And so by going to the groups, the brokers and the people that you have to build relationships with to get into these deals, they're then willing to help you grow your platform, because then you have a relationship, right? They know you'll buy from them. They know you'll trust them. So that was a big step for us, going from these kind of smaller, call it $5, $6, $7 million deals into the more $20, $30, $50 million deals, in understanding the different buyers and sellers and what their expectations were, how we needed to react. Little things like when you go buy from an institution, your clock starts when you sign the LOI. It doesn't start when you sign the PSA. Your letter of intent starts your clock, and it's not going to be more than 60 days. And so if you can't close in 60 days, you might be in trouble. So like that's the market I live in today. It's very aggressive, and if you can't perform,
so speed and releasing some non-refundable earnest money.
It's closing sometimes. I mean, sometimes you can buy a 30-day extension from them with additional earnest money, but sometimes you can't. Sometimes they just expect the deal to be done in 60 days, and you're one of 3 or 4 in the best and final. You'll submit an offer. They'll analyze it. They'll go what they call best and final. Then they'll call you. They'll say, okay, now what's your real best number? And then they'll select the buyer. And so you go through this
existing, office buildings and so forth.
Yeah.
Something that has a development piece related to it, because that's a whole different ballgame.
Yeah, this is more of an existing thing, though. Development timelines are also incredibly compressed around here, just because of competition for dirt. So you still aren't going to get the classic 180 days. I'm not going to close until I have permits. That just doesn't exist either. So you really have to understand the market that you're investing into and what the expectations are. And it can be a little bit shell-shocking when you go from, the mom and pop and the smaller assets up into this larger asset class. It's super fun. It's super exciting. When you win a deal, it's awesome.
How do you win a deal?
Reputation. Honestly, we win deals by being local boots on the ground. So we work with very specific brokers. We really try. I always say less is more. So we have a handful of brokers that we work really well with, and we've worked our way up into their top 1 or 2 guys by closing deals, quite frankly, and doing what we say we're going to do and not retrading. And when you get into that level of success and you have that relationship, then it starts to branch out. So they, this broker or this guy will will pull in another guy in his office, maybe in a different market or maybe in a different asset class, and be like, hey, you should put these guys at the top of your list as well. So now all of a sudden you have that in. So it kind of propagates.
Mass or something like that, right? So tell us.
But
Go ahead.
I said it takes really dedicated focus to build very specific relationships in the market and with the brokers that kind of control the market to be successful. I mean, you have to play the game.
Right. What's been the hardest part for you guys, and what has not gone right?
I think the hardest part for us, we've had deal challenges. We went out of state, we went to Colorado, and we ended up, Colorado specifically, if you ask people that invest there, have some really tough tax laws occurring right now. And that really hit us pretty hard. So we invested in a couple assets out there. We had property taxes that were $13 a foot on our triple net expenses.
Jeez.
So when you buy an asset that's at $7 tax rate and you're like, okay, that's already high, and your property tax goes to 13, your tenants just can't afford to absorb that. So your base level rent goes down. And we went from $22, $23 to 14 or 15.
Oh, geez.
So we got out of those deals. One deal we made 10% over 3 years. So I think it was like a 3 IRR.
These are just
the other deal
supposable deals that had a hiccup.
Yeah. I mean, we made it out whole on both. We made small profits on both in reality, although essentially negligible to the point of not talking about. But we worked our tails off, and our investors all respected us for the effort we put in. I think that was,
was that an unforeseen circumstance, like something changed in the tax law and, unforeseen, or did you guys,
It was unforeseen. I mean, it was a change in the way they administered their tax law. They have this concept, and it's actually seeing more and more ground across the country, where you have kind of sub-municipalities, if you will. So a developer can go in, create a municipality for as little development. The city makes you do all this infrastructure costs, so lights, blah, 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 sewer, all these connections. There's all this cost. Well, you can then create a municipality around your development and charge a tax on top of that. And then the developer takes that guaranteed tax income and sells it off as a bond into the bond markets. And you end up with these additional tax liabilities. And the way that got implemented, and then the way the city increased underlying taxes, caused that to increase exponentially. And so it was just like this huge hit across the state on how taxes were administered.
So is that really like a due diligence review line item wherever you're investing, or are you guys trying to stick just in the Pacific Northwest now? That scare you from?
Yeah, we pulled back. We've been in Colorado, Oregon, and Washington, and we would look at industrial in Portland, but we don't. Really for us, we just said, let's go be, with the size of company we are, we've done pushing 250 million on deals. We just decided, let's go be experts in the Puget Sound. Let's focus on office and industrial. Let's make the right relationships and the right connections to where we get the calls, and let's grow that way first. And then if we get to the point where we really, truly can't fill our needs within our market, we might consider it in the future. But right now, we have a very core focus on office and industrial in the Puget Sound. That's it. That's what we do.
And is that because industrial fits the business model for OZ the best?
Yes, for us. I mean, we are building industrial anyway, so it's a great fit for us. There are people that are building multifamily and opportunity zones, but we do not compete in multifamily, and we don't want to.
Right. Stick with what you know.
So one thing.
Let's wrap it up with where you're headed. Your little hint on your.
Yeah. I say our core focus is office and industrial. We are looking at doing two interesting things over the next period of time. We're looking at potentially launching a REIT, and we would consider, depending on what our investors' appetite is, rolling our current portfolio into that REIT. We have a really great cash flowing portfolio right now that would be a great base for that.
And why would you do that? Why would you and Joe choose to do that?
We have some pretty interesting concepts on some tax advantages that we can take advantage of that allow for us to convert into a REIT without an initial tax hit. So it's like avoiding the sale essentially, and then producing long-term cash flow for our investors. We love the idea of holding real estate long-term versus kind of the fix and flip mentality. So that's something that we just think is wealth generation at this point. Then the other thing we're looking at, actually we're not looking at, and I'm going to touch on this super lightly, and then maybe in 6 months you guys call Joe back. Joe has been spearheading with another group in Texas, actually, about a single family REIT. So this is already pretty deep into implementation, but it's kind of single family rentals. Think about it like a multifamily portfolio in a way, but with some pretty exciting tax advantages. So that's something.
Single family, not multifamily, right?
It's all single family stuff, but there's a way we can get significant assets. I mean, BlackRock is doing similar stuff as well, but that's something that is actually pretty deep into the implementation stage. That we are going to be, SmartCap will be an owner in that organization as well.
Okay, and looking to continue to pick up single family properties in certain markets?
Yeah, absolutely. There's a strategy that will kind of unravel in the next few months on how we're picking up those properties, what it looks like. So we'll come out with a whole marketing campaign associated with it with those guys. But that's been something I quite frankly have been very minimally involved in, but Joe's been spearheading that for us, and it's getting very close to launching, and we have a lot of interest in it already. So
and is that going to be single family in certain markets that are more affordable, not touching off this way?
Yeah, we're not necessarily looking at the Seattle market right now.
Right. Okay. Well, I'll be interested to hear what's up. Yeah. On that, would love to. I have somebody I'd love to introduce you to. We'll talk later about that, just to put the local minds together on maybe complementary type of stuff. Good for you guys, but we'll talk about that later as well. So this is
absolutely
exciting. I mean, so let me ask the last question: if somebody's sitting in a 1031 right now, can they take funds out of the 1031 into your OZ fund?
Yeah, absolutely. I mean, as long as they don't execute their 1031, then there's no reason, as long as they're within the time frames. I always say, consult your CPA. We're not financial advisors. We're not giving you tax advice, but as long as you're within the time frames, it shouldn't be an issue.
And what's the minimum that you're looking for?
Our minimums across all our funds are $25,000. We average closer to $100,000 to $125,000 across our investor base.
Okay. Good stuff, you guys. Exchange. If you're sitting up there in Exchange, give SmartCap a call.
It's an option. Yeah, it's an option.
And so you have something available now?
Yeah, we have an Opportunity Zone fund open right now. We're just solidifying our project, so we actually expect to kind of send out our final marketing documents probably in the next 2 or 3 weeks, I'd guess. And my expectation is that'll close out very quickly. And then we have Fund 3, which is our blind fund, which is our suburban office fund that we are just launching right now as well. That will be open very soon. And we have about $12 million left to place in Fund 2. So we would potentially kind of JV with Fund 3 if we needed to for a larger asset. Nice.
And how can people get more information about SmartCap or get on your email list and so forth?
Yeah, info@smartcapgroup.com, or if you go to our website, you can log into our portal and register there. And if you register on our website, we reach out to every investor and start a communication process that way. So both are options.
And what are you guys in need of right now? Is there something that you're like, oh, we need to work on this. Oh, we need this resource. Oh, we need something. What is it that your needs are right now?
Our biggest need, which I hope we just solved, was we just hired another acquisitions guy. We just can't keep up with the deals we're seeing. But I mean, if you look at our 2 long poles, we're always raising money. and we're always looking for great deals in our marketplace. Most of what we like to see is off market. So that's that's something that's obviously attractive to us. So whether it's an opportunity on land, an opportunity on a building.
And what's the smallest size building you want to buy these days for value add?
We would buy, for the right asset, we might look down to 5, 7, or 8 million, somewhere in that range, but really ideally 10 million up. We are looking at a tower right now that's a long shot. It would be off market. We'd be lobbing a offer over a fence, if you will. But we have some institutional partners that are super interested in that. So I don't know that we have a cap, but we really, under about 10 million starts to get less interesting. We'd look maybe down to 5 or 6 for something in Pioneer Square or something in like a really key location that we wanted to be in. We would reach down a little.
For the industrial dirt?
What was the question? Sorry.
Where are you looking for? Are you still looking to pick up more industrial dirt for the OZ stuff?
Yeah. So I think I got your phone's kind of being fuzzy again, but industrial dirt, we're looking really from Arlington markets south all the way down to kind of Lacey, Frederickson, DuPont, in those markets. So pretty big scope. It's really hard to find stuff in Kent Valley. Everett's getting hard, but we definitely are interested in those markets. Very interested.
Good stuff. Well, we appreciate your time today, Tim. And
yeah, this was great.
Super long today. This is, these are the experts in our market, guys. So if you want to learn more about OZ funds or you want to, invest, these are the guys probably to look at for that locally here. And we're happy to know you. So thanks again. We'll have you guys, we'll check back in with you guys, every, 6 to 9 months and see what's going on. I think you'll be all right.
Definitely reach out to Joe, keep in contact with him. He'll be the next conversation you want to have. And I think over the next, 3 to 6 months, we'll have some interesting news to share. So could be a fun future conversation.
Can't wait. All right, guys, that's it for today. We went super long, so we're not going to jump into a bunch of admin details today. Joe Bauer, can you link podcast number 65, like I said, episode 65 with Joe Allis, Tim's partner, so people can listen to both here at the same time and get the full story? Would
Absolutely.
Be super awesome. And as a reminder, you guys, the Pacific Northwest Big Badass Wealth Expo is coming up here in July 10th through the 12th in Seattle. Tickets are on sale right now. I think the ticket price is going to change March 19th. So you better get on it. And that is the place to be this summer for the largest investor conference here in the Pacific Northwest. And we hope to see you there. That's hosted by Fixated on Real Estate, our friends Tarl and Grace Yarber. Many of you know. But if you are listening from out of state, it's going to be something that you might want to show up for and come meet us all. Come say hello. We'll be there. Other than that, check out Seattle Investors Club meetup page on meetup.com for all our weekly meetups, where we can keep the conversation going and mastermind and coaching and bring in deals and small group networking, which is super powerful. So I hope to see you guys all there. Other than that, Joe, stay safe on the road. Wear your helmet, your seatbelt. What else? What else we got? We're all good. I'm ready to sign off. Over and out, everybody.
All right. Thank you guys so much.
See you guys.
Bye-bye.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.